If you're thinking about buying a new car this year, stop. 2026 might be the worst time in history to do it. Prices are still near record highs, interest rates are brutal, and new government rules are about to make things even more expensive. In this video, we're going deep into why 2026 is a trap year for new car buyers. What's causing it, how automakers are gaming the system, and what smart people are doing instead. Welcome back to Car Hacks and Money, the channel where we decode the truth about cars, cash, and how to outsmart the system that's designed to drain your wallet. If you're rebuying a car in 2026, or even thinking about it, this is the video you can't afford to skip. Let's start with the biggest question. Why are car prices still sky high when everyone said they'd fall by now? You've probably heard this story before, but here's the real reason prices haven't dropped. When COVID hit, automakers shut down. They lost years of production. Supply chains froze. And unlike toilet paper, you can't just make up missing cars later. That means there are millions fewer vehicles in circulation today. Fewer lease returns, fewer trade-ins, fewer affordable options. Fast forward to 2026, and that shortage still hasn't been fixed. We're missing almost 8 million cars from the used market that should have existed by now. That is why your new car still costs like luxury, even if it is not. Here's what they don't tell you. Car companies don't want prices to go back down. During the pandemic, automakers discovered something wild. They could sell fewer cars, make more profit, and train consumers to accept higher prices. So instead of flooding the market with cheap models, they cut them. Cars like the Chevy Spark, Nissan Versa, and Toyota Yaris are gone. Now they focus on high-margin SUVs, trucks, and luxury trims. They're making less volume, but earning record profits. That's why the cheap new car is now an endangered species. In 2019, the average new car in the US cost around $37,000. In 2026, it's closing in on $50,000. And it's not just inflation. It's because every new car is loaded with tech giant screens, AI systems, driver assistance sensors, and complex software updates. It sounds cool until you realize every new feature adds cost. And when something breaks, it's not a $200 fix anymore, it's a $2,000 repair. The more tech goes into cars, the harder it becomes for prices to ever drop again. Now add financing to that. In 2026, the average new car loan interest rate is 7% to 9%, the highest in 2 decades. That means a $50,000 car could end up costing you over $65,000 after interest. And yet dealers advertise it as just $799 a month. They're restretching loans to 84 or even 96 months, trapping people in debt for nearly a decade. By the time you finish paying off that new car, it's worth half as much and the tech inside is outdated. Modern cars are incredible, but they're also over-engineered. Everything runs through computers, sensors, and subscription systems. And here's the catch. Fixing them costs a fortune. Need a new headlight? It's not a bulb. It's a $1,200 assembly. Got a software issue? You need a dealer visit, not a screwdriver. Worse, many new cars now have digital locks on repairs, meaning only dealerships can do certain fixes. So you're not just paying more upfront, you're locked into an ecosystem that keeps charging you for years. 2026 is the year subscriptions hit the car industry hard. Want heated seats? Pay monthly? Remote start? Pay monthly. Performance mode? You guessed it, pay monthly. BMW, Mercedes, and even Toyota are testing this system. And it's not just luxury brands. Automakers have realized they can turn every car feature into a recurring revenue stream. So even after you buy the car, you're still renting features. It's brilliant for them, and brutal for you. Here's where things get worse. Tech-packed cars depreciate faster. That $50,000 crossover loaded with touchscreens might lose 40% of its value in 3 years. Not because it is unreliable, but because the tech inside becomes obsolete. Used buyers don't want outdated software or expensive repairs. So when you trade in, your top trim model suddenly isn't worth much. Cars are starting to depreciate like smartphones, fast and ugly. Electric cars were supposed to make things better. But in 2026, they're adding to the chaos. Battery prices have stabilized, but repair costs haven't. A single EV battery replacement can still cost $10,000, $25,000. And now, early EVs from 2018 to 2020 are flooding the used market, with degraded range and high repair bills. That's making buyers nervous. They're holding back, waiting for better batteries, which means fewer people buying new EVs right now. So automakers are stuck with inventory, offering discounts that aren't really deals once you factor in financing and fees. The car market isn't just local anymore, it's global. 2026 is seeing major supply chain pressure again. Lithium, steel, and semiconductor prices are rising. Political tension and shipping costs are up. That all flows directly into car prices. Even if inflation cools, material and transport costs are keeping sticker prices high. In short, it's not just greed. It's global economics, and you're footing the bill. So, should you wait to buy? Yes, and here's why. Experts predict the new car market will stabilize after 2026. Factories are back at full production, and automakers have overcommitted to AEV investments. That means more competition, more discounts, and more inventory. But it'll take 12 to 18 months to hit showrooms. If you can hold off until late 2027, you'll likely save 10 to 20% on the same vehicle. That's thousands of dollars just for being patient. But if you must buy now, here's how to win. Go used, not new. A lightly used 2023 or 2024 model gives you 90% of the features for 30% less. Buy in cash or short-term financing. Avoid 6 to 8-year loans. They're wealth killers. Skip the high trims. You don't need the $4,000 tech package. Go for reliability, not flash. Avoid first-year models. Let someone else beta test the new tech for you. Negotiate out-the-door pricing. Ignore monthly payments. Focus on the total cost. Dealerships are making record profits in 2026. Not because they're selling more cars, but because they're charging insane markups and hidden fees. Market adjustment stickers, mandatory add-ons, and protection packages are pure profit. Even cars with manufacturer discounts are often marked back up by the dealer. Your best defense? Ask for a full out-the-door quote in writing, and don't be afraid to walk away. The minute you show confidence, the price usually drops. 13. The tech reset coming, 19 o'clock to 2030. Here's the good news. By 2027 to 2028, the tech side of cars will stabilize. Automakers are finally unifying software systems, subscription backlash is growing, and laws are being passed against feature gating. That means cars released after 2027 could be simpler, more reliable, and easier to repair. But 2026 is the messy middle, the worst mix of high prices, unproven tech, and unstable financing. By 2030, owning a car might not even look the same. Car subscriptions, rideshare credits, and AI-assisted leasing programs are being tested globally. That means in just a few years, buying a new car outright might be as rare as buying a DVD player. We're re-entering the mobility-as-a-service era, and 2026 is the last gasp of the old model. That's why automakers are squeezing every dollar they can right now. So here it is, 2026 ISN, just a bad year to buy a new car? It is a trap year. You'll pay record prices, record interest, and deal with record depreciation, all while automakers and dealers cash in. But if you stay smart, patient, and strategic, you can dodge the chaos entirely. Cars are changing. The economy's changing. But your wallet doesn't have to suffer with it. If you found this breakdown helpful, hit like, subscribe, and share it. It helps more people avoid the 2026 car trap. This is Car Hacks and Money, where we turn automotive chaos into smart financial wins. See you in the next one.